Welcome to your commercial-free, uninterrupted investment show, sponsored by the SEC-registered investment firm, Wilsey Asset Management, a fiduciary firm owned and operated by President Brent Wilsey, who has been putting clients' investment needs first for over 40 years. The Smart Investing Show has been giving unbiased financial information for over 27 years on local radio stations right here in San Diego, providing you with fundamental analysis on stocks and investments you want to know about. Now, here are your hosts, Brent and Chase Wilsey.
Well, good morning and welcome to the Smart Investing Show. I'm Brent Wilsey, just about 8:02 on a Saturday morning. Great to have you here this Saturday morning and every Saturday morning talking about your money, the economy. Inflation's another one we talk about here. Jobs reports coming up. So a lot of things to make you a smarter investor. And with me is Chase. Good morning, Chase.
Good morning.
Well, let's get right to that jobs report. Or should we talk about, let's just mention it because I was surprised this morning that Bitcoin was down as much as 20% overnight because of risk-off fears.
But I thought it was an inflation hedge. It's not. So Bitcoin is going to trade as it's going to trade. There's no inflation hedge in my opinion. I don't see the correlation there. There's no statistical evidence. It hasn't been around long enough to actually witness an inflationary period. So I think it's more going to trade based off the risk-off type environment rather than the inflation type environment.
And the reason I'm bringing it up is to just bring out the volatility that you're going to have with that. And it's just a crazy thing to do. So
I it's not just Bitcoin. I was looking at an article yesterday, and I mean, some of these IPOs, have you seen Robinhood lately?
I have not.
It hit as high as 85. It's now at 21, I believe.
21?
Wow,
that's like a 75% decline.
Yeah, and I mean, another one that we looked at yesterday actually was DocuSign. Fell 42% in a single day.
Right.
And if you want more information on DocuSign, be sure to go to our YouTube channel, Smart Investing with Brent and Chase Wilsey. You can see the video where we actually break down DocuSign. I mean, I'm going to say it's not surprising when you actually break down the numbers for DocuSign.
Yeah.
But there's this environment where I think people are starting to realize all that free money is no longer going to be the case.
Right. And what could happen, too, is it could compound to where just like it begins a snowball building going down the road or down the mountain because of the fact that the more that it falls, the more people get out, the more that it falls because there's no reason to stay on to it. Whereas value companies say, wait a minute, this is a food company. They just increased their dividends. She has great earnings. But when you have these growth companies, there's nothing there but the momentum. And once that's gone, it falls quickly.
Yeah. And one thing I'm going to say, just kind of deviating off topic, but with Bitcoin,
we've done that 3 times.
I know. With Bitcoin, if you hold Bitcoin and it's down and you have a loss in it, there's no wash sale rules with Bitcoin at this time. So I would highly recommend if you have lots of gains in your portfolio, sell the Bitcoin, buy it back because there's no wash sale.
There's not.
Yeah, and I think that is extremely wrong.
Right.
And that's one thing that Congress is actually going for.
Right.
And I think that's right. I don't think that's a fair thing to have. You can recognize the loss, then buy it back. It's crazy. But if you have it, I would strongly recommend doing that because.
Are you saying to sell it, then buy it back?
Yeah. Oh, no. Well, if you are an advocate of Bitcoin, I would say do that. But
Bitcoin trader.
Personally, I don't hold Bitcoin, so I'd never do that. But
I'm sure some people fell off the chair like, what?
Yeah.
Chase is saying Bitcoin's a buy?
Anyways.
You're saying if you play that game, it's a favor for you that you don't have to worry about the wash show.
But again, I think that's another reason that Bitcoin's been under pressure lately is the scrutiny from Congress, which I think is right. I don't think that's a fair thing that can occur.
Yeah, well, let's get to the jobs report. I just want to mention the Bitcoin thing because it was such a surprise this morning when I saw it. But the jobs report looked like a big disappointment yesterday morning with payrolls increasing just 210,000, far below the estimate of 573,000. There were, however, some bright spots in areas that could help ease the inflation concerns. This includes manufacturing, which saw an increase of 31,000 jobs, and transportation and warehousing, which saw an increase of 49,700 jobs. Breaking out the transportation industry, we saw an increase of 26,800 jobs for workers who pick up and deliver mail and packages, and jobs in warehousing and storage facilities.
Yeah, that actually climbed for the warehousing and storage facilities was up 8,800. And, I think this is so important because the infrastructure of moving products and building products. If we don't have the products, that's what's going to create
Yeah.
inflation. This should kind of help ease is what I'm looking at. But two areas of surprise were retail, which saw a loss of 20,400 jobs, and leisure and hospitality, which gained just 23,000 jobs. I was pretty surprised by the retail side, as with a busy holiday season, you would expect more workers. And on the leisure and hospitality side, the lackluster number comes after a gain of 170,000 in October and 108,000 in September. Even though the industry has added 2.4 million jobs in 2021, it is still 7.9% or 1.3 million jobs lower compared to February 2020. And I mean, overall, I'd say that the report looks better than it shows on the surface, but I'd say it's just okay.
And just a small indication, you and your fiance Taylor went to dinner last night at UTC, and I think you said the restaurant was packed, the mall was packed, and it's just like a lot of people.
Yeah, it's like Omni what? No, Omicron. But I will say that the thing is, we went to dinner and then we went shopping, and I was a little disappointed. I think it has to do with staffing.
Right.
Is most time holiday hours are 9 p.m. A lot of stores were closed by 8 p.m. So
Really? I
we
thought they-
couldn't even go to a couple stores or
Wow.
several stores.
Yeah, because if they open at 12 o'clock in the afternoon,
Mhm.
I mean 8 o'clock is 8 hour day, so it could be, and maybe, I believe the retail jobs are there, but just maybe people say, I don't want to work.
Yeah,
You know,
I
so I don't know.
I was just surprised by that. We also do one of our favorite restaurants was saying that they're not opening up inside yet, not because
Yeah.
they don't want to, but they just don't have the cooks to provide enough food to do the delivery, do the outdoor dining and the indoor dining.
Right.
So I mean, there's still some shortages there that are impacting a lot of these businesses, and I'd say even the small businesses to a higher degree.
And that's our favorite restaurant in Scripps Ranch, Yanni's Bistro, which, gosh, I've gone there for years. And Yanni and Denise, they've run that for years as well. Great restaurant. If you haven't gone there, go to Yanni's Bistro right off of 15 in Scripps Ranch. Let's go on to the employment report that comes out on a monthly basis. Can be difficult to understand. Many people aren't aware that the headline data actually comes from two different sources. The first is a payroll survey called the Current Employment Status Survey of Employers, which shows the headline number of how many jobs were added. In the recent report, the headline number was just 210,000 jobs. The second is a household survey called the Current Population Survey of Households, which reports a headline unemployment rate and participation rate.
Yeah, and the household survey showed a much rosier picture, actually, as the unemployment rate fell from 4.6% to 4.2%. So that's very strong. And the labor force participation rate, which I think is going to be crucial. I mean, that's where, we want to make sure people are excited and participating in the labor force. That actually rose to 61.8%, which was the highest level since March 2020. So that's a good sign. The strange thing, though, is the household survey showed a huge difference in job growth with an estimated addition of 1.1 million jobs. I believe this will likely lead to a revision upwards for the 210,000 jobs that was reported by the payroll survey. I think there's just going to be a meeting in between.
Right.
And the thing that I will say is I think the payroll data, I think it's better. The reason for that is the household survey does take a smaller sample, interviewing just 60,000 households. And you compare that to the employer survey that looks at 145,000 businesses and government agencies, which covers about 697,000 work sites, or about 1/3 of all payroll workers. So I think as I said, the employer survey, I think that's going to be more accurate just because you're hitting a larger sample. But I do think I wouldn't be surprised to see an upward revision to that 210,000 next month.
Yeah, and that could very well happen, because that would be like, oh, look what happened. It was different and so forth. The one thing I want to say, I mean, you probably remember statistics and so forth. It depends on the sample they take of that 60,000. Is it a good sample? Is it really very diversified across the country? Or is it focused on one area? I mean, that's one thing we can't find that data on. But it could be a good sample. But even if it's a bad one, it still says that, wait a minute, 1 million versus 200,000, something's not right here. So I think with what we're seeing, I think that 210,000 jobs is low. There's something missing there. So and I do remember, I don't think it's happened lately, but back during COVID, some states weren't getting in all their numbers right away. Now, maybe with the labor shortage, they're not having their they're people doing as quick as a job or something. I don't know. So
Yeah, and the other interesting thing too is, I mean, you talk about being kind of late with the data. Is the survey only is for one payroll in the month. It's kind of that mid payroll. So it's
Right.
not like you look at the entire month of November. It's just one payroll that occurred. So it's an interesting survey. It's not going to be perfect. It's also going to be extremely difficult to collect the employment status of every single American out there. So it's not a perfect survey, but it gives you still an idea of what's going on with the employment world.
yeah, and it's something that's important. And again, and also too, I don't know anybody personally that is not working. Everybody I know is working, has a job, self-employed, something. Where before, when things get really kind of bad, like one person, maybe two people that don't have a job. I don't know anybody right now that doesn't have a job.
Yeah, that wants one.
That wants, yeah. Well,
My grandpa's not working.
well, that's in the working age category.
Well, not even in the working age, but wanting to work.
Wanting to work, right? That's where there are some 80-year-olds that are working. So,
Yeah.
all right, our president? No, not quite. Yet. All right. Unfortunately, over the years, many times a small investor gets the left holding the bag as stocks drop dramatically. I worry this could be the case again as inflation continues to rise with the prospect of higher interest rates, which will hurt future cash flows of growth stocks, which will make them less attractive.
And this kind of comes back to what we were saying at the beginning with Robinhood and DocuSign. I think you're going to continue to see these growth stocks get pummeled. But institutional investors have drawn more than $2 billion out of U.S. tech-focused mutual and exchange-traded funds in the first half of November. Will the small investor get out in time, or will they continue to ride the emotional wave and, again, be left holding that bag once again, as history has proven?
And it's such a shame because we talk about it on the Smart Investing Show over and over and over again. Like, oh, well, you guys, you're wrong. And so, well, we might leave the party early. But again, I always tell people I'd rather leave the party early than leave late and be drunk and fall down the stairs and you lose everything,
Or we just don't even go to the dangerous parties.
I was going to say that. We don't leave. We leave the dangerous party, but we're at another more subdued party that's kind of like, okay, everybody's, listen to piano music and they're much more calmer and you can still make money on investments. We're not saying go to cash 100%.
Yeah.
We're saying find the investments that are reasonably valued and they're still out there, and also be patient to buy those investments.
Yeah.
So I do want to mention real quick before we go to the calls, by the way, phone number is 866-577-2473. That's 866-577-2473. As always, that will get you through for your unbiased, no strings attached. I do see we got Jim and Alpine already there, so Jim, you'll be first up, but you want to call in, join the show again, 866-577-2473. Well, good news, bad news with oil this past week on the oil front. OPEC and Russia have decided to increase their collective production by another 400,000 barrels starting in January.
And this will help with the supply side and help reduce prices at the pump a little bit. I'm still not super sold on the idea because 400,000 barrels I don't think is really going to move the needle too much. I mean, if you look at it in a singular type element, yes, that is a benefit,
right?
But there's other external factors that I think
it's
are
called
going
a small step in the right direction.
Yeah, we'll call it that.
Right.
But the bad news is while we have the capacity to produce that oil ourselves, we are forced to have, again, other countries benefit from our demand, and we have to ship it on these tankers to bring it to our country rather than drilling it here.
Yeah, it's just frustrating. But again, we want to point out that it could be a movement in the right direction to reduce the price of oil, reduce the price of gas. So we'll see. But what does concern us too is that right now Europe is kind of in a lockdown, not a lockdown, but a close down, we'll call it. What happens when Europe reopens? There's going to be more demand on the world oil situation. So that's what worries us.
Yeah, and it's not just Europe. I mean, there's other areas of the world, as you said, that are being impacted more heavily by COVID than we are here in the U.S., and that they're not on the same track in terms of their economy kind of growing as it was pre-COVID.
Yep, and I think we could see that change in the springtime. So, and I think there'll be a big demand on oil. And actually, some have predicted oil at $150 a barrel. I don't think we'll see that, but I think we could see 100 next year. So, unless some miracle happens and we start producing oil here in the U.S. again, but we'll see.
It's not gonna happen.
I'm trying to be optimistic. Come on. All right. Phone number is 866-577-2473. That's 866-577-2473. Let's go up to Alpine and speak with Jim. Jim, you are on the Smart Investing Show. Brent Chase, how can we help you?
Well, I'm looking for a miracle this morning. Speaking of the miracles you were just speaking of. Anyway, Prudential. I got some position in that, and it's been very good to me. And I'm thinking about buying some more. And again, as always, I'm looking at the feasibility of ongoing dividend payments.
So is Prudential the miracle you're looking for? What's the miracle that you're looking for, Jim?
No, you spoke tongue in cheek about a miracle just before you picked up the phone.
Right.
I'm talking.
So you're hoping that we produce oil here too, is what you're hoping for the miracle? Is that
Yes,
correct?
I do. Yes,
Okay,
I do.
all right. And I think you said you're looking at adding to Prudential, so you hold it already. Are you up? You down? Where do you stand?
Oh no, I'm significantly up. In fact, it's throwing my portfolio way out of balance.
Oh,
But I don't feel like paying any capital gains on it. But I thought about buying some more because it seems very solid.
all right.
And in these times, it's nice to have things that are at least somewhat solid.
Yes. Yeah. Well, in all times, I have solid investments, and I guess I'm just not. I'm more risk adverse. But let's say look at Prudential. Their symbol is PRU. They are in the life insurance industry. Not much float shortage there, 1.8%. Surprised at only 58% of institutional ownership there. I thought that would be higher. We do have a great start on the PE ratio, 5.6. That is still below the industry at 8.3. Price of sales, 0.6, same as the industry. Price to book value, 0.6 versus 1. And then price of cash flow. Now, this is strange. It's 20.5 versus 3.3. I'm not sure why the cash flow is so expensive compared to the industry. And then they have a nice PEG ratio, price earnings divided by growth going forward, of a 1 versus 10.4. Now, no earnings change over the past year, which is surprising to me. Could be they just report earnings maybe, but there's nothing there. Well, maybe the earnings aren't possible over the past year because rest of the industry was 123% growth there. 5-year industry growth, 11.6 versus 12.3. Sales growth for Prudential 1 year is 17.2. Industry saw a decline of 3.5. And the 5-year sales growth for Prudential is 3.3 versus 7.2. The 5-year earnings per share growth estimate for Prudential, 8.5. Very good. Industry's at 4.3. They do pay a dividend. Nice dividend here, still at 4.5%. Only use 25% of their earnings to pay that dividend out. They have grown that dividend for 10 years now. Buyback yield, 5.4%. So they're very active increasing that dividend and also buying back shares. The balance sheet of financial company, so there's no current ratio. We do see a debt to equity looking pretty good here, 0.3 versus 1.6. Net profit margin also looking good for Prudential, 10.4 versus 7.2. And return on equity, 11.7. I usually like around 15 or better, but even the industry is only at 12.5.
Yeah, and looking at the current price here for Prudential, it's $102.73. 52-week high, $115.52. On a low, $74.58. I mean, it's had a really strong year here. I'm sure you're aware of that. Jim holding it, but it's up 37.9%. Looking forward, too, for Prudential. I mean, gosh, this looks quite nice. Estimated earnings per share for December 2022, well, that's $12.42. Would give us a target sell price of $206.17. I mean, these are generally the types of businesses I like. I like insurance businesses. Talked about this in the past on the show, but insurance businesses write their policies to win. I mean, they're not going to underwrite bad policies where they lose money on. So it's generally, I think, a very safe business. That it's very profitable. I like it here. And one thing I would add as a caveat is just, again, one thing with Prudential is I think they're more in like life.
Yeah. And
that's something that does concern me a little bit more. I'm not sure the breakdown of the policies that they sell.
And that's one thing I was going to bring up, Jim, was that how much of their business, how's it broken down? How much comes from the life insurance business? How much comes from annuities? I believe it's a high amount. We generally like insurance, property and casualty insurance companies because they can raise their premiums. Now, I think it was 12 months ago, we had talked about and did on our newsletter, and I think we talked here on the radio show as well, that life insurance companies are having problems because of the low rates on interest. They couldn't really make a profit off it because it's so low. So I'd want to know a little bit more about Prudential. I mean, they're looking pretty good on the numbers, but I'd want to understand more how they make their money, and could that be an issue going down the road? Now, we should see interest rates rise, which could be positive for them. But still, I'd want to know more about the business and look at the 10Q, 10K to kind of find out more where the money comes from. All righty?
Sure. No, it's a good point about, heavily into life insurance versus property and casualty. Excellent point about not being able to raise rates unless you sell new policies, pretty much.
Yep. So, and you want to watch for that, the mortality, and then also to cancellations as well. So that's what you want to look at. And I have a feeling their business is diversified, but I don't invest on feelings. I want to invest on looking the facts and like, yep, that is correct. But check into it before you add any more money to it. And percentage-wise, how much does it make up of your portfolio?
Well, it's climbed to like 15%. It's, like I said, it's been a very healthy year, and I own a bunch of it.
Yeah, I'd say I'd probably at 15%. I'd still do the research we recommended, but I think I'd look for another insurance company as opposed to adding more to Prudential. I think that would put you over concentrated.
And I think you're okay. I know you mentioned worries about selling, and I think 15%, that's about the cap we'll look at, like being too heavy. I mean, if it were to go to 20, that's when I'd really consider pulling back. But at 15, I still think you're okay as long as the story checks out for Prudential.
Yeah, I wouldn't sell here, but I definitely wouldn't add to it because then you have a problem. All right, Jim?
Well, at the risk of overstaying my welcome, I do own Unum as well. So,
which one?
Unum, UNM.
Oh,
another insurance.
Yep, I think we have looked at that one before.
Yeah.
I think, yeah, and I think we did like that one as well. So, well, it might be time to diversify out of insurance. You might have too much insurance in your portfolio and find another industry.
I've got a lot of diversification, but
Good.
I was looking at that going, man, this has been really a fun year with this company. I wonder if it's going to keep going.
Yeah.
What are the chances?
Yeah. I just
couldn't performance and all that.
Yeah. Don't add to it. Because if it feels good, it's done well. I mean, you got to really diversify there.
Yeah.
That's our recommendation. All right, Jim.
All right, folks. Well, have at it and keep going and have a wonderful day. Thanks as always.
You too. Have a great weekend. All right. Bye-bye. All right. That opens the phone line, 866-577-2473. That's 866-577-2473. Let's go up to San Marcos and speak with Phil. Phil, you're on the Smart Invest Show. Brent Chase. How can we help you?
Hey, guys. I called in before. We talked a little bit about Viacom, VIAC. I heeded your advice, and I've been watching it plummet. I saw some news, Sherry Redstone, and then I'm drawing a blank on the president's name that runs the operations. They did, there was a insider trading where they purchased quite a bit of their stock at the 35 level. So I made a first round there, and this is going to be, I'm going to get your input on Viacom, but I've actually, as the stock has continued to go down, I've made I've done 3 overall purchases.
Uh-huh.
So one at the low 35s, it dropped to like 33, did another one then, it dropped even down to like 29. I fired a third bullet. I'm curious, are you guys, we're in something together, and I saw you guys do a rebuy on something. Mm-hmm. I'm curious on your take on that, and first of all, what do you think on Viacom? And then even when you believe in something and it continues to drop, do you still want to try and buy more, but not over leverage yourself?
Let me kind of give you like a summary of how we invest, because what we do, we run a concentrated portfolio. So when we step in, if we were to buy Viacom, we would buy right off the bat 6% of the portfolio. So say we bought it, I'm just going to throw out numbers here, at 35. It went down to 30, we would not step in and buy more because we have a pretty good position already. Viacom would have to probably drop down to, I'm going to say around the $20 range before we kind of looked at saying, you know what, it fell down. It's down about 40%. We really like this business. We think it's being mispriced. At that point in time, we'd probably step in to bring our position back up to a 6% holding. So that's how we do it. I'm not sure how you started off buying it. I know some people do a little bit. We spend so much time researching something. When we buy it, we say, yes, this is worth 6% of the portfolio.
And the other thing too, Phil, that you might be talking about in our portfolio that we did is, I think what that particular trade was actually tax loss harvesting.
Oh, yeah.
So we added to that position. So in 30 days we can sell the first shares and take that loss without running the risk of having the stock appreciate. So we will look at adding, as Brent said, if it, let's say it dips down to 3-4% of the portfolio, yeah, we might, if we really like it, add back to 6%. Or if there's a decline, we may look at that tax loss harvesting opportunity to buy back the shares that we own, double them up, and then 30 days later we'll sell the first shares that we bought to take that loss and help with taxes.
Yeah, so there's different scenarios. I'm glad you brought that up, Chase. I forgot about the tax loss.
Yeah, because I know what Phil's talking about, and I think
Okay.
I know he has an account with us. So I want to make sure I was talking about the right thing. You might be like, "Whoa, you guys bought a lot of it."
Yeah, Chase, that's interesting because in a way, you're on that tax loss harvesting. You're selling off the higher shares, right, and taking the loss on that, and then making the rest of your portfolio at a lower cost average, correct?
Yeah, essentially we're deferring the taxes, taking that tax benefit this year, and then we'll continue to hold that position longer term.
I mean, Viacom, they've been getting worked for like a month.
See that.
They finally had their first green day yesterday. I'm at about 9%, and now I almost feel like I don't want to fire another bullet. But I was curious to get your guys' input because, all the PE ratios and things like that, they look completely undervalued. And I like some of the things that they're doing. So, I'm curious.
Yeah, I know this is one that we kind of looked at, and we decided not to buy it yet, but you bringing it up, we may revisit it again in more detail. But let's look at the numbers for you and the listeners here. Again, the company is Viacom. CBS, symbol is VIAC. We do see PE ratio, very good. You're right, 6.4 versus 33.9. Price of sales, 0.7 versus 3.1. Price to book value, 1 versus 3.7. We do see price of cash flow also looking very valuable at 14.4 versus 19. Now, the company does not have a PEG ratio, which, again, is your price earnings divided by growth, so I'm kind of curious why they do not, but we'll see that going forward on the earnings. The earnings over the last 1 year are up 127%, better than the industry, up 109%. 5-year average 6% versus 8.1. The sales for Viacom actually over the 1 year did change by 5.9%. Industry was down 0.4. The sales over the 5 years have done very well for Viacom, 13.7, about 3 times the industry at 4.2. Now, we do see a 5-year estimated earnings per share growth here of a negative 6.3 for Viacom versus 26. So I can't wait till Chase looks at the earnings going forward because something seems to be wrong here, which I just can't see at this point. We do see they pay a nice dividend of 3.1%, only use 19% of the earnings to pay that out. The balance sheet, we've got a current ratio of 1.7 versus 1.1. Debt to equity looking very good. It's 90% versus 360% for the industry, so I like seeing that. Also, too, intangible assets, they got 35%. That's below the industry at 55%. We do see a net profit margin of 12, above the industry at 10.5. Return on equity is 16 versus 11.4. And even return on capital is good, 10.8 versus 9.9. Chase, what do you got going forward here in this company?
Yeah, I mean, to kind of quote Phil here, he said they've been getting worked, and they definitely have. Current price here, $31.07, 52-week high, $100.97. The low, $28.90. So year to date, they're down about 15.4%. But again, off that high tremendously. And I believe they were the ones that kind of got wrapped up in that hedge fund that was like buying. I think he was buying the options. It blew up on him.
Yep.
I mean, it's kind of craziness, and it looks like Viacom's kind of taken on the chin since then. But looking at the numbers for Viacom going forward, December 2022 estimated earnings per share of $3.96 would give us a target sell price here. Gosh, if we use our 16.6 multiple. Gosh, having struggles with the calculator here.
Yeah.
It'd give us a target sell price of about $65 a share. which again looks phenomenal on the earnings side. I'm just very concerned, I would say, with in this streaming environment where it's growing and growing and growing in popularity. Why do the analysts have a estimated growth rate that is so negative on this stock? Are they, if they can't kind of take market share here, there could be some big problems. And I know they have I think they have Pluto TV. I don't know how popular that is.
They have Paramount too, right? Is that
Yeah, Paramount. I think
Paramount
that's
Plus. Yep.
yeah, that's their. I think their big ticket here, in my opinion. And I think the one upside to this is a potential acquisition target.
Right.
But especially at these levels.
I know it. And I
are they window dressing themselves for an acquisition? Is what I was thinking.
It could be. A lot of times they don't like to be the acquired. They want to be the acquirees. Well, they want to be and I think there's just a lot of turmoil maybe in the executive suite up there that they can't maybe agree on things or something, because I don't see anything wrong with this business, and I think it's worth looking more research into it, because I think we started looking around 50, I believe, wasn't it?
A few years ago, actually, we started looking at around 19, I want to say, 19, 20.
But then we revisited again when it fell, and I thought it was around 50. Phil, I'm glad you called, because now at 31 is well, and I think before we said, well, there could be more to be let out of the bag here. Maybe this is it.
And they do have some good assets there. I mean, you talk about Paramount. I mean, they're creating the content. CBS, it's more of a platform, I would say. Yeah. But I don't know if CBS produces any content. But the point I'm trying to get across here is I worry about kind of the linear TV, the broadcast studios, like the actual station owners. I worry about that type of business. As long as you're producing the content, it's not going to matter if it's streaming or if you're selling it to the studios. I like that they produce their content.
And I have heard that local news is going to be something that's going to survive. And I believe, and this is why I want to check into it, I believe they have local stations as well. So these are things that I'm kind of asking a question format that you're going to answer, because if you get the right answers, I don't think I'd buy percentage-wise. Phil, how much is it making up of the portfolio?
About 9.
9, yeah. So I would definitely not add more to it, but I would do more research on it, do some more reading on it. I'm not sure when they reported earnings, when their last conference call was. Maybe they have some good news on there. September 30th was the last time. Go through that. We love reading the conference calls, listening to them, because they'll bring out things that can answer questions. And this may not be fixed, next week, next month, maybe even next year. But gosh, if you buy it, and we'll just say in 5 years from now, it goes up to 60, not even the 100 it was at, you doubled your money practically. So I like looking into this one.
And I'd say kind of to play on your words there, Phil, I think you might be out of bullets to use on Viacom. But 9%, yeah, because you'd hate it if there is something that does go wrong with this business. You don't want to keep adding to it. You might not be able to kind of buy at a lower price, but if it goes down from, let's say, 30 to 25, but 2 years later, it's again at 50 even, well, you still did pretty well on it. So I'd say be patient with it. After doing a little bit more research, numbers on the surface look quite good, though. Yeah,
and also, too, being a client of ours, if we buy it, you're going to be really overconcentrated buying your portfolio for you.
Right. When you guys listen in on their calls, does Sherry Redstone, does she sound savvy, intelligent? That's my only concern with the company.
And I don't know.
She's not as savvy as her dad.
Yeah, I feel like Bob Backish kind of runs the show there.
I've not listened to their conference calls. Have you listened?
No, I haven't either. So
because we haven't gotten that far yet. We're doing the deep research on it. We kind of looked at it before. I remember it looked pretty good, but we weren't quite ready. I probably would want to now. But it's an interesting point. That's one thing, too. When you read the conference calls, you can't get out the tone of their voice and stuff and what you're saying. And that's why I sometimes like to read them and then listen to them, because you can get different mannerisms that they're talking. Like, you're right. Like, gosh, is she as sharp as her dad was? I don't know. So, good point.
Yeah, and I appreciate all the advice, guys.
All right, Phil. Well, thanks for calling, and do some reading there on Viacom there. All righty?
I will. Thanks again. Have a good weekend.
You too. Bye-bye.
Yeah, that does bring up an interesting point on Viacom, though, is I do wonder kind of that control, like how much control does Sherry Redstone still have of that
Yep.
company? As I said, I do think Bob Backish is kind of heavily relied upon to run a lot of the show there, but
Right.
I know it's kind of I don't like almost like a Rupert Murdoch type event where
Mhm.
the family's so in control of it. Would she consider selling? You,
Yeah.
you know, and does she have that power to kind of trump the shareholders? And that's one thing that does worry me about some stocks is when the founder or the family that owns a company, if they can kind of overcome shareholder questions, that could be very problematic.
Yeah, and these are things, again, when we talk about do more research on it. These are the type of research you want to do because it is curious. I mean, how much does she own? What's the executive side? What are they doing? I mean, I don't know why this company's struggling so much. Why it's such a great buy now, apparently by the numbers. But that's when you want to do the research because you want to make sure that's not going to be at 15 a year from now because the problem continued on. So you got to find out what the problem is. Why did it go from 100 all the way down to 31?
And I don't know if it's the case, but one thing that I hate to see is when companies issue super like voting stocks.
Yeah.
And basically you can't kick the CEO out.
Right.
Because they're the founder. Like, I don't want to lose my company, which I understand.
Right.
But as a shareholder, I mean, what if the CEO goes off the rails, is drinking all the time?
Oh, yeah.
You can't kick me out. I own all the voting power here. I don't
Do you
like
know
to,
they have voting power?
I'm just saying,
they
generally,
can. Right.
if I see a stock that has kind of the super voting shares, I don't like to really go near it because that CEO has too much power, and if there are problems, you can't get rid of them.
Yeah. So, phone numbers 866-577-2473. That's 866-577-2473. And as always, they get you for that unbiased, no strings attached, front of opinion about what you want to talk about. And actually, look over, all lines are open. Oh, actually, you know what? Actually, it's just about time for a financial planning segment. Did you have something?
Yeah, I was just going to say real quick before we go to Harrison, I just want to, again, kind of promote our YouTube channel one more time. I think a lot of callers and listeners of the show that like how we break down these stocks. We do this in a video format now on YouTube, so you can go and see different stocks. And we even go in a little bit more detail because we have the time to really focus on that company. Just go to our YouTube channel, Smart Investing with Brent and Chase Wilsey. Just type that in on YouTube. You'll see all the videos we've done. It's also our news segments are on there as well. Mm-hmm. But the big thing I think people are starting to like is that Smart Investing weekly stock analysis is what we call it. And the recent one we did was DocuSign. We've talked about Rivian. There's been some good heavy-hitting names that we've discussed.
And, here on the radio, we talk about the numbers. On the YouTube video, you can actually see the numbers we're looking at. Mm-hmm. So that is, I think, very helpful because, and again, we explain the numbers, but I think to see it while we're talking would be very helpful for them.
And the cool thing is, on radio, you can't rewind us. On YouTube, if you're watching it and you miss something, you can just kind of push back on it. So it's kind of helpful if you're trying to learn more.
They can go to the podcast afterwards.
I know.
Yeah, so good. All righty. Phone number is 866-577-2473. That's 866-577-2473. All lines are open. But right now, let's talk to our financial planner, Harrison Johnson. Good morning, Harrison. How you doing this morning?
Good morning, guys. I'm doing well.
Good.
I'm in San Diego. I think this is the first time I've been in San Diego on a weekend since the middle of October. So
I know, yeah. Be our travel expert.
Happy you are. Harrison and I are delivering some Christmas trees today for our charity.
Oh, really?
Yeah.
Very cool.
Mm-hmm. That's right. So after this, I'm heading over to Chase's. So.
Well, I'm very happy here today that we're talking about the power of tax-deferred growth. I mean, this is such a strong thing that I think people get so tied up in short-term gains that they don't think about the power that the tax-deferred growth. Explain to us.
Yes, I've been wanting to talk about this for a while, but the other day I read an article, and in it basically was saying that 401ks are bad because all the growth that you have inside of that 401k is ultimately going to be taxed as ordinary income instead of receiving the preferential capital gain treatment. So because of that, 401ks are no good because you're being overtaxed on it. And that in itself can be a compelling argument if you don't really understand how that growth works and how it changes over time. So when most people think about retirement accounts, on the 401k IRA side, you get a deduction or it's pre-tax, so you get a tax benefit now. With a Roth account, you have tax-free withdrawals. So in other words, you're choosing, do you want your tax benefit now or later? But I don't think people fully appreciate the value of the growth inside of those accounts. So investment growth either comes from capital gains in the form of appreciation, dividend income, or interest income. Now, dividend and interest income is going to be taxable when you receive it, whether or not that money is reinvested or withdrawn or distributed to you. Just the fact that you have dividends and interest means that you have taxable income for that year that gets reported on your federal and state tax return. Capital gains are taxable when they're sold, so you have a little bit of control of when that is going to happen. Interest income is taxable as ordinary income, where if you hold a position for over a year, then its capital gains and its dividends will receive a lower tax rate, the capital gain rate. But if you hold that position less than a year, then both the capital gain and its dividends are going to be taxed as ordinary income. So on the federal side, that preferential treatment might mean that your capital gain tax rate is going to be 15%, where states, including California, most states just treat all income the same. There's no difference between ordinary income and capital gain income. So on the state side, you might have a 9.3% tax rate. So together, 15.9 plus 9.3 is 24.3%. Now, if you have a non-retirement account or a taxable account, your turnover, your dividend yield, your performance will all determine total how much taxes you're going to pay. But that rate, when you do pay taxes, could be 24, 25%. And because of this, if we look at the return that you're having, you could be losing 1.5 to 2.5% per year just because of the taxes you are paying, because it's not tax deferred. So if you're averaging 10% a year, well, your after-tax return might be 8%. And the more time you have invested, the bigger that difference is going to be between a tax-deferred account and a non-deferred account because of the compounding. So, for example, if you have $100,000 in a tax-deferred account earning 10%, after 30 years, that could grow to around $1.75 million. Where if you have the exact same investment, but it's held in a non-deferred account, now that might be only $1 million, which is a difference of $750,000. So retirement accounts are very efficient, not just because of the deduction or the withdrawals, but the fact that they are able to avoid taxation on a year-to-year basis.
And Harrison, these are one of the tools that people don't realize how valuable they are. They kind of look at the short term of it. Again, you just gave us some samples, which I know when people come in to see you, you probably do in more detail on their own personal portfolio. But it really is a big thing. It's kind of like it adds it, because we heard about the magic of compounding. Well, this kind of turbocharges it because you don't pay taxes on that compounding.
I was going to say, too, is with that tax deduction, if you live in California and you want to retire in, let's say, Florida, I think you are making the biggest mistake by not taking that tax deduction, because right now you're paying state income tax of, let's say, 9.3% is the number Harrison used. Well, guess what? If you get that tax deduction, you're not going to have to pay taxes in Florida when you pull it out. So in California, I mean, the IRA, 401k, the traditional methodology there of getting that tax deduction now, I think is so huge because we have such high taxes here in our state.
And be careful. I think I see the people from the Franchise Tax Board coming down saying, hey, you're telling people to leave California, Chase. But it is so important, Harrison, to kind of look at that. And, these are many things that you do for your clients to show them how to meet their goals and so forth. So thanks for sharing that, and we'll see you on Monday.
All right. Thanks, guys. We'll see you Monday.
Okay. Bye-bye. Again, that's Harrison Johnson, our CFP, our financial planner, helping out many, many people, getting a lot of phone calls now because of the way he does it. So different than anybody else. And we tell people, if you're not a financial planner, come and see Harrison first and see what the differences are. He is available for a free consultation. Go to the website, smartinvesting2000.com. That's smartinvesting2000.com. Or call him at the office, 858-546-4306. That's 858-546-4306. And he's on a salary. He doesn't sell any products at all. So it really is an unbiased financial plan he does for you.
Yeah, I mean, the big thing is he does true tax planning.
Yep.
He doesn't file the taxes, but a lot of times people make mistakes and then they ask, oh, did I do the right thing? well, actually, if you would have done it this way, you would have saved on your taxes.
Yep.
That's why he's there, is to really help make sure you're optimizing your tax situation. That's what a lot of people like in using his services.
Yep. Alrighty, phone numbers here, 866-577-2473. That's 866-577-2473. Let's go out to San Diego and speak with Lois. Lois, you're on the Smart Invest Show. Brent Chase, how can we help you?
Good morning, Brent and Chase.
Good morning.
I am looking at getting my grandchildren some stock for Christmas.
Okay.
And I was reading online last night about investing in concrete.
Mm-hmm.
I wanted your opinion about that.
Well, there are concrete companies out there. And one thing that we have noticed just in general, because of the infrastructure bill that passed, a lot of concrete companies, a lot of steel companies have really become overpriced. How old are your kids, Lois?
Well, the youngest is 10, and then the oldest is 20.
20. Okay, so kind of you might get a different stock for each one. What I was thinking, and we've not looked at it, I know that Disney has fallen from, I want to say close to 200 down to 140. I don't know if it's a buy now or not. We've not looked at the numbers on it. But I was thinking for the 10-year-old, maybe get the 10-year-old some shares of Disney if it's a good buy. And again, I want to preface that because we're not buying it yet in our portfolio. We may not buy it, but we're just I'm kind of throwing things out here for you. For the older one, you might want to look at a gaming company. There's some gaming companies that have pulled back. He might have more interest in that because if it's something that they have interest into, hopefully they will enjoy it more. If you buy a concrete company for a 10-year-old, I don't think he's going to have much interest in that. Maybe in the 20-year-old, they don't really care. So try to get a good investment. And again, it's got to be a good investment. Got to have good value to it, but something that they might have some interest in because they deal with it on a personal level.
Yeah. I think it's an awesome idea. I think that's something Brent would do for me when I was a kid. Well, actually, he did it for me in high school. When I started to learn about money, I was like, wow, this is really cool. So I think that's awesome. But I do think, not all kids were like me, or especially in high school, like, oh, wow, that's really interesting. But I think Brent's right. If you can find something that they like, that it still makes sense. And, because concrete, I don't know, 10-year-old, well, what is U.S. concrete? I don't care about that.
And it may sound like a solid investment, but it might be overpriced is my concern, and no interest there. So, and also too, I mean, Lois, you can kind of listen to, the show. Again, we did just bring out CBS Viacom, which is, Channel 8,
I think they have Nickelodeon, which,
there you go. So that could be. And that one on the surface looks pretty good. I don't know if you heard us talking about it to the gentleman before, but it looks pretty good. There could be some problems with it. But again, if they do have Nickelodeon, some of the shows, Paramount, maybe both of them would enjoy it, So, but I'm not saying it's a great investment. It appears to be worth the research. I mean, it was 100, now at 31. If you're not going to do any research on it, I would say probably worth the roll of the dice on that one.
Yeah.
So, all righty?
Okay, thank you so much.
Okay, Lois, thanks for calling. Have a good one. Let us know what you get. Let us know what you get for Christmas for him. All righty.
Okay. Bye-bye.
Bye-bye. All righty. That does open the phone line. 866-577-2473. That's 866-577-2473. And it's funny. It used to be that you could actually get these stock certificates and give them at Christmas time. Well, can't do that any longer because some of those certificates are really pretty cool. I remember Disney had all their characters on it and so forth. But to get an email here I want to look at here. It says, hello, guys. I love your show. Can you look at either of these stocks, OXLC or NLY? I own both and may buy more. And this is from Jeff. So let's take a look at OXLC.
I was going to say, what's the other one?
NLY. That's, I think, new. We looked at the other one before.
Annaly Capital.
Yeah, we looked at that one before. Okay. So that's why I thought we'd look at this other one because this one is Oxford Lane Capital. So it's a different company as opposed to Annaly Capital. So we're going to look at the numbers on that. Symbol is OXLC. They are an asset management company. Nothing on the float on short, no institutional ownership is showing here. Wow, this is very strange. PE ratio 2.2 versus 9.5. Price to sales, though, 2.6 versus 3.3. Price to book value, 1.2 versus 1.8. And price to tangible book value, 1.2 versus 12.7, and no price of cash flow versus 26. No PEG ratio going forward. No earnings per share or sales for the last 1 year or 5 year. I'm not sure what's going on with that. We do say, and I think I know why that Jeff likes this. I see a dividend yield here of 11.2%, only using 22.4% of their earnings to pay that out. That sounds very attractive. We do see that their balance sheet, again, they're a financial company, so no current ratio, debt to equity looking good, 0.1 or 10% versus 90%. We do see a net profit margin 99% versus 32.8. I mean, these numbers are just looking way too good to be true here. I almost feel like maybe they sold off some big asset or something to get such high numbers, which what you'd have to do here, Jeff, is go to the financial statement, go to the income statement, go to the balance sheet, see some big moves there somewhere. Any earnings going forward in this, Chase?
It's very strange. I'll give the current price here first. It's $8.04. 52-week high, $8.53. The low, $5.15. Market cap, it is quite I'm going to say it's a smaller company. It's just $947 million is the current market cap. Unfortunately, I checked multiple sources here. There's not even an analyst tab that I can go to get estimated earnings per share. So I'm out of information here.
Yeah, out of information. I mean, and Jeff, what you can do here is I want to read more about the company. What did the company do? How they make their money? It doesn't appear to be a REIT. Sometimes you see REITs here. It doesn't appear to be that. It seems to be an actual management company.
Are they like a BlackRock, I wonder?
Well, yeah.
Or Black? I always get them confused. I think Blackstone.
Yeah. No, BlackRock.
Okay.
BlackRock.
Yeah. I know there's
yeah, and Blackstone is something else. But BlackRock, in a very small scale. BlackRock is like, I think, $1 trillion. Huge. This one is very small. So, and I know it's attractive is that dividend, but there's just very strange numbers here. And what you have to do, Jeff, is kind of spend some time with the financial statements. I would also, again, listen to the conference call. What is this company doing? Because it just seems with that dividend yield of what I say was 10.8%, too good to be true. And some of the numbers, I mean, the PE ratio of 2.2, that kind of tells me I think they sold an asset or something. That's just, 2 years to get back what you pay in the stock. That's not normal.
Yeah, it's very weird.
Yep. So, alrighty. Phone number is 866-577-2473. That's 866-577-2473. Jess,
I don't like this.
Wow.
I just looked it up. So Oxford Capital is a closed-ended fund launched and managed by Oxford Lane Management and invests in fixed income securities. Okay, fine. Problem here, the fund primarily invests in securitization vehicles, which in turn invest in senior secured loans made to companies whose debt is rated below investment grade or is unrated. So they're loaning to these companies that,
yeah, very high risk.
Yes. So that's probably how they're getting the high yield. It's almost more of a debt instrument than an equity, I'd say.
Yeah, and I see the high for the stock was about 8.53, the low 5.13. If it would go back down to that low, it would take you years to get back, even that high dividend, if they didn't cut the dividend. So,
and be careful with it. Very high risk.
Yes. Alrighty, let's go to San Diego and speak with Adam. Adam, you're on the Smart Investor with Brent Chase. How can we help you?
Good morning, guys. Thanks for having me.
Sure. Thanks for being there.
Absolutely. I have a question. I work for a company, and they're pretty big, ABM. And I was kind of thinking of maybe investing in that company, but on the other hand, I didn't know if it's a good idea, so I wanted to see what you guys had to say about that.
Well, it can be if you don't go overboard. Sometimes employers will give a discount for buying their own stock. You do know a little bit more about the company because you go there every day. Be careful about thinking too much about the company because things in the executive suite can go on that you don't know about. But you want to be careful about going overboard. And this happened to people many years ago, about 20 years ago with Enron, where it was such a great deal and everybody's working there, putting the stock in their 401k. Well, when things fell apart, they lost not only their job, they lost their investments as well. So I think to have some in that, if it is a good company, the fundamentals look good on it, it's worth it. And especially if they do give you a discount for actually buying their own stock.
Yeah, I agree with Brent there. I mean, it's, I think, a hard thing for a lot of employees because many times you don't go to a place that you hate. If you hate working there, you're probably not going to work there anymore. So a lot of times I think people kind of build that affinity to the company. Oh, it's a great stock because it's just a great company, and I get it because I work there. And without looking at the fundamentals, you kind of build that emotional tie to it. and kind of start to, I think, make excuses for it. And sometimes it works out. Don't get me wrong. People that, worked at Qualcomm in 1995, they did great with buying the stock.
That's true.
But other people, as you said, with Enron, that was very dangerous. You lost everything. So you got to always break it down based off the fundamentals and make sure that the investment makes sense on top of it being a great place to work.
Yeah. And what's the company that you work for, Adam?
ABM. That was a good thing that you said about not trying to think too much, because ABM is working with Biomed Realty, which I think is Blackstone, or I think you may have mentioned them a second ago.
Oh, BlackRock.
And people are showing up like at some of the buildings we take care of, like and they're talking about like selling them, to take a look if they want to buy them and things like that. I mean, I don't understand what's totally going on, but I don't like the idea of buildings that I take care of or my colleagues take care of being looked at to be sold. So
yeah, that could be an issue.
And I'm having a hard time having it load here. What does ABM do?
ABM, they take care of buildings, their facilities management. Their core statement is building value.
Is that their symbol, ABM?
Mm-hmm.
It is.
I think it is. Yeah.
Yeah.
ABM Industries, right? Okay, let's just. We got about 2 minutes here.
I think we can run through it real quick.
Yeah. Let's see.
Sure.
Yeah, come up with some numbers here for us. There we go. Okay, so real quick, PE ratio 21 versus 26. Price to sales 0.5 versus 2.6. That's good. No price to tangible book value. That's not good. PEG growth is 0.8 versus 6.3. That's positive. Just looking at some quick numbers here. You get a dividend of 1.7%. Use 35%. The balance sheet, debt to equity 50% versus 110. So that's positive. They have grown their earnings and sales over the last 1 and 5 years. Very quickly, I don't know if you have any comments.
Yeah.
Comments there, Chase.
Yeah, I do. Current price here for IBM, $44.73. I mean, it's off the 52-week high of $55.48, but also off the 52-week low at $36.31. I mean, the future earnings look quite attractive for ABM, as October 2022, I see it's $3.47. Would give us a target sell price of $57.61. I mean, trades at a forward PE of about 12, 13 times. So that's a positive. And also, too, we'd be going out to 2023 here shortly. So on the surface here, Adam, I mean, the numbers look pretty good for ABM. Of course, we always say do more research on it, but I think it could make some sense, especially if you get a discount to buy some stock here.
And Adam, the other thing you do, too, is listen to the conference calls. I mean, you can listen to your high bosses, your CEO, the CFO, what they're talking about, because maybe they'll tell why those buildings are being sold or why they're not being sold. So I listen when I'm walking, I listen in my car and so forth, because we have about 30 companies we listen to. But you can find them very enjoyable because of the fact that they're telling you what's going to happen in the future with your job, so to speak.
Right. And how do you access that stuff?
If you actually go just even Google, or you go to the company's website, there's an investor relations tab. A lot of times the conference call and the earnings presentation, the SEC filings, that'll all be on the investor relations part of the company website.
Okay, so if you get a public company, they're going to make sure that's accessible on their website?
Yeah, legally they have to.
They have to.
Okay.
All righty.
That's great. Will you guys be interested in touching on Blackstone a little bit? Because we have an interesting relationship with them through, I believe, a private company they call Biomed.
This time we don't have time. I know he just gave us the symbol or the signal that we got about probably 15 seconds left here. Before we
call in maybe next week or the following week, and we'll be back here. So we'll be happy to take a look at Blackstone.
Okay, sounds good.
Okay, Adam, thanks for calling. There's the closing bell. So thank you for listening to the Smart Investing Show. It is for informational purposes only and should not be used as investment advice. If you'd like to discuss in more detail your investment needs, have other investment questions, feel free to call myself, Brent Wilsey, or Chase Wilsey at 858-546-4306. That's 858-546-4306. Or visit our website, smartinvesting2000.com. smartinvesting2000.com. And for more daily educational information on investment tips, go to our Facebook page, Smart Investing, Brent Chase Wilsey. Thanks for listening to the show today. We'll be back next week right here on the Smart Investing Show. Have a great weekend. Talk with you soon.
To think that I did all that, and may I say was shot.